This is the Market Comment by Heralam Buspisuros. I'm Cristina Marujos, and thank you for joining us at XM.com. The U.S. dollar surged against all its major counterparts on Tuesday as the U.S. CPI data revealed that inflation in the world's largest economy is not cooling as fast as expected. Both headline and core inflation accelerated in monthly terms in January, taking the headline year-on-year rate lower but not as low as expected, and keeping the core rate unchanged at 3.9% year-on-year. Market participants threw out of the window any remaining chances of a March rate cut, and the total number of basis points worth of rate reductions for the whole year has fallen to 95. Given that there is still room for the market to take its projections closer to the Fed's dot plot, the greenback may continue to benefit should data keep suggesting that the U.S. economy could be reaccelerating. Dollar-yen climbed above the psychological round number of 150 following the U.S. inflation numbers, a move that spurred Japanese officials to once again express concerns about the yen's sharp declines, adding that appropriate actions will be taken if needed. The yen stabilized after the remarks, but with the Bank of Japan pushing back against expectations of an imminent rate hike and the Fed implied path being revised up day by day, it may be hard for the yen to stage a strong comeback without an actual intervention episode. The pound extended its suffering against the US dollar today after data showed that UK inflation did not accelerate in January as it was forecast. That said, it did not slow either, with both the headline and core CPI rates holding steady at 4 and 5.1% year-on-year respectively. The next test for pound traders may be tomorrow's preliminary GDP data for Q4. The forecast points to another 0.1% contraction, which will confirm a technical recession and perhaps prompt investors to start adding to their rate cut bets, despite the Bank of England's higher for longer message. On Wall Street, all three of its main indices fell more than 1% after the US CPIs, with the tech-heavy Nasdaq losing the most, as expectations of higher interest rates mean higher borrowing costs for companies and lower present values for firms that are valued by discounting expected future cash flows. Gold also suffered after the U.S. inflation data, as both the dollar and treasury yields rose. However, the precious metal has not entered a bear market yet, as the stalemate of ceasefire talks in the Middle East is still allowing for some safe haven flows. Thanks for watching today's market comment here at XM.com.